the core parts of the economy have been pretty much in recession or at least very stagnant growth. But in the meantime, we just had a lot of tech earnings this week and the beats are just gangbusters.
There's a big difference between what's actually happening in the economy and being bearish there versus what's happening with stock prices. The administration is aware of all this stuff. They just don't know how to solve it.
They're kind of willingly letting some of the air out of the bubble. But hell or high water, the only way to win midterms next year is to 1, lift Main Street out of recession, 2, fire up your base, and 3, get markets cooking back to highs.
This episode is brought to you by Grayscale, your trusted gateway to more than 30 different crypto investment products. You'll hear more about them later in the episode. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another Roundup edition of Forward Guidance. We are recording amidst the longest government shutdown in history now, officially, I think as of a couple days ago. We're getting into the meat of it, month 2. What's going on, guys?
We should protest Mike and Jason. We should shut down.
We want a raise.
Yeah, I want a raise.
Give me a raise.
Man, what's going on in the U.S.? Like, it's just so crazy to me that you guys are still having to pay taxes while the government shut down and all the Congress people are getting paid. And
what's the boomers, man?
What's going on?
Tyler's rants are deserved. I mean, this is a shutdown, just grandstanding and like absolutely screwing over everyday people because these politicians. It's no wonder Mid-Money won. Like, why would you vote for Cuomo? The guy's the same ilk that that got us into all these problems. Like,
did you see the breakdown of voters by how many years they've lived in New York City? It was like all the old school New Yorkers voted for that guy Silva, and then they've been there like 10 years plus, and then Cuomo was like 5 years, and then Mamdani was like 2 to 3 years. It was kind of interesting, but regardless, I mean, I'm shocked that everyone's shocked at this. Like,
exactly,
it's so obviously K-shaped economy. The trickle down economics is not working. There's something fundamentally broken with markets and wages, et cetera. Like, so I don't know. Maybe it's a good sign that things are going to get. I don't know how to feel about it yet, but it's a sign.
It's very forthturning, Yes, like it's right on. Like, yeah, if you're a believer in that way to think about things, like this makes a lot of sense to you. Like, of course, as wealth disparity gets worse, as inflation gets worse, as the K-shaped economy gets worse, and nothing that we're doing is going to reverse these. Of course, these types of people are going to win, and I think it's only going to accelerate from here.
He's the tip of the spear. Trump's the tip of the spear. He's the tip of the spear. All people know is burn it down if you're just going to keep leaving them behind.
The interesting thing is we haven't seen like an outrageous amount of like credit stress, which is the odd thing. It's been very isolated to like autos or credit cards, etc. It hasn't been systemic, which is maybe a sign it's so centralized that like a lot of it is being held in private equity or corporate balance sheets rather than, retail now.
Yeah, you want to give us a market structure update? Because it's a weird situation. Go ahead, Quinn. We'll jump into that.
Well, I was going to say we could jump right into the slides because I know, Felix, you have some economic data there, and I put some things in there too. The thing is these companies been in a recession Felix, go to slide 9. I have the ISM manufacturing. I mean, Main Street, all the high yield borrowers been in a recession for a year and a half now. This slide. Yep. So this shows the ISM manufacturing index, versus historical recessions. The index is pointing to a contraction every month since March 2025. 34 of the 36 months since November 2022, the index has shown declining activity, punctuated by only the briefest of upturns in January and Feb 25. Manufacturing has never been this weak for this long in 8 decades since the end of the Second World War. The downturn has been too shallow to be a genuine recession, but has lasted much longer than any ordinary soft patch. So, all the high yield issuers, not to say that credit spreads can't erupt and rupture more, but these guys have been in a recession for so long now that it's just kind of, they figured it out. I mean, small businesses just showed a $10,000 job decline this month in the ADP stuff. So, the high yield guys, the corporates, the large cap tech, everybody, they're booming, but these guys been screwed for so long and that's who's in HYG in the spreads,
Check this one out. This is slide 32. This is total share of population in economic expansion. And it just goes to show this is part of the economy
insane.
Absolutely getting roasted, to your point. And, to shout out to Jack Farley, he had Stephen Myron on his podcast, Breaking News Jack Farley. You got to give props to the
Jack Farley,
who started Forward Guidance too. But he basically said a lot of this stuff is why he was so dovish on lowering rates. And I'm wondering when that starts getting priced in, because it's clear they're aware of it. The administration is aware of all this stuff. They just don't know how to solve it. And I'm wondering when that actually clicks and stuff starts happening, because these things can roll on themselves if they go fast enough. But
that brings up something I've been thinking a lot about, which is just this, bifurcation of the tools of monetary policy are just not well suited for a highly inflationary world that we're in now. And so they don't really know what to do. I mean, you could view this through the lens of stagflation, but I think it's more nuanced than that. Like, it's the characterization of the K-shaped. I'd be curious to go back and look at the 70s, whether we had this back then too, just this K-shapedness, because changes in Fed funds rate, like you have on one leg that we just looked at, which is just so much of the core parts of the economy have been pretty much in recession, or at least very stagnant growth. But in the meantime, like, we just had a lot of tech earnings this week, and the beats are just like gangbusters. Like, earnings are doing fantastic, so you have that going on, and then the complete opposite in the rest of the world.
Well, yeah, it's really odd. Like, Mike Green said this on a podcast today too. He said there's a big difference between what's actually happening in the economy and being bearish there versus what's happening with stock prices. And generally speaking, it's really bearish in the stock market, but because of the market structure and passive and all the different systematic ways people manage money, that's why you get stuff like slide 29. Check this out. This is wild. You see market cap weighted indices, tech related versus defensive industries. It's the widest dispersion there's ever been. And what you really get is when this happens in the asset inflation in certain sectors, you get gambling. And that's, I think, what we're seeing right now, market structure wise, is just a lot of chop, because like we talked about last week, which is retail investors got all bulled up on the breakout. They buy call options. Now we're in this period of earnings come through, implied volatility drops as the event risk drops. Your calls are burning in delta. So retail sells their calls, then the broker sells the delta, stocks go lower, and you have this, like, basically it's vol goes lower, stocks go lower type phenomenon in all the winning sectors. So that's got to work its way through in terms of what's going on in the market structure, and vice versa. Look at how neglected, because of all the flows. It's like defensive sectors have just been left for dead. It's the market's broken. It's all the flows. This is when you make everything. It's like a giant factory, and you optimize the factory perfectly, but for scale. But you end up putting slop in the sausage, and then it gives you cancer. We're at the cancer stage now. Like, it's very clear to me that we're at the cancer stage, and that cancer stage could melt up if the government just like pumps it, or you could have a crash. Like, it's such a polarized outcome. It's driving me crazy, and probably pretty much everyone else watching this. Here's one other thing I want to just talk about real quick. Go to slide 34. These are just some of the Goldman baskets I watch. So, and this is from 1 day action, 5 day action, 1 month action, year-to-date action. So this first one it's not Goldman, it's Morgan Stanley's momentum basket. It's up 101% on the year. This is getting taken to the cleaners, because this is ground zero of where all the retail bought their call options. vice versa, similarly with Bitcoin, the Bitcoin basket kind of getting worked over. But the third one is where I want to concentrate. This is the Goldman Sachs middle income basket, where like middle income consumers, it's down year to date 17%. And so if you go to the next chart, you can see what that looks like on a chart basis. So this is to your exact point, Felix. Nothing is getting through the middle class. They're getting not only that, but if you just go off the chart, the middle class is getting absolutely waxed. And I think their answer is vote Mamdani, vote for handouts now because the system's not working for you.
Yeah, I don't even know.
Honest,
they want handouts. They just want to be able to put food on the table, I think.
Yeah, but you end up polarizing society, right? Is what I'm saying. Is like it works for
this
food.
Honestly makes me a lot more sympathetic to the idea that, again, shout out Jack Farley getting the Moran podcast appearance, but I'm kind of sympathetic to the ways that Moran and like Besson have been talking about things, which is they're more dovish on rates and more hawkish on the balance sheet, and that's been kind of confusing to me because it feels like a lot of people are hoping for, okay, they're just going to expand the balance sheet a bunch. But if you listen to especially what Besson's talking about, they want to almost go towards like a scarce reserve system. To them, QE has been one of the great poisons of the last decade or so. And it seems like they want to be more hawkish on that side of the balance sheet, but actually ease on the Fed funds, on the short rates, because that's what might have a more direct trickle through into the core economy. The small businesses that are taking loans priced off SOFR versus, if you just rip a bunch of QE, all that's good for is tech behemoths to issue bonds at a premium to fund more AI capex. Like, that's not doing anything, If you're thinking about crypto investing but don't want to open a new account or manage keys and wallets, check out Grayscale. Grayscale has been offering trusted crypto investment products for over a decade, with 30 and plus counting, including single asset funds like Bitcoin and Ethereum, diversified portfolios, and thematic exposure to the broader digital asset space. Many of their products are available directly through your brokerage or IRA, just like a stock or ETF. Investing involves risks, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Yeah, there's so many dimensions of the problems of the past administrations they're working through right now. So the one is the inflation is because of the government spending. Inflation is a fiscal, monetary, driven phenomena. So the reason inflation is starting to come down, you can directly link it, services to government spending. And this is the first time in many, many years that government spending growth has gone in this direction, declining year over year from Biden's last year. So inflation is a problem. We all know fiscal dominance is a result of the government spending. They are actively working on that and making progress. Secondarily, to support that, over the top government spending has been Fed intervention to keep the bond market in check that otherwise wouldn't be. And part of that is their unequal balance sheet policy that you just mentioned that screwed lower incomes and helped the big tech and corporates. So they're reversing both of those at a time that big tech is 40%, Meg 7's 40% of the stock market. So if you correct the things that have been floating big tech, then you just de facto correct the stock market. And they're trying to do this without causing pain that eventually reduces tax revenues and then blows out the deficit even more. But, you look at these earnings, it shows you how far the Overton window has shifted towards big tech, that OpenAI would even say or request, we want government backing. What the heck? Get out of here.
They walked that back a little bit today,
but think of the confidence and arrogance and this. That's just a sign of the times. How exuberant you have to be to even say that as a private startup. What? Why? And so, the government's been funneling since 2021, and even through with Trump's admin to AI. So it's no wonder these companies are blowing out earnings. But yeah, the thing I reflected on, over the last couple of weeks and following the Fed meeting was we talk about this reflexivity. It's so reflexive either direction. You pump liquidity, stocks go up, spending goes up, top 50%, top 10% earners control 50% spending, all this. It's super reflexive to the upside. Okay, we saw that. Now, the thing is, things aren't just okay where the Fed can step back and not support liquidity. They have to be there. And in a normal course, okay, the Fed pushes a rate cut back, out a couple months and removes balance sheet accommodation. Okay, market declines, corrects, but things float along okay. You can't do that here. So you have this downside reflexivity risk growing when the government shut down. Growth scare is already tip of the tongue, and the Fed pulled their rate cut support hawkishly. And what people aren't understanding is, yes, they ended QT, which was $5 billion a month, but they changed the reinvestment program of MBS to only go to bills instead of match balance sheet composition of treasuries, which is 80-20. So de facto, those changes actually add, over $10 billion basically of duration into the market every month instead of what everyone's celebrating of ending QT. And worse yet, signals more of that to come because they want to normalize the balance sheet. So there was a huge hawkish pivot from like a rate cut and balance sheet perspective. And you just so there's no reason to step in it right now until and you already have the growth scare and Main Street's screwed. So this is a bad setup. I guess we don't own enough gold.
And then look at slide 30. This is the other thing. This is the interest expense as a percentage of revenue for the government. They stole this from Zero Hedge. So 23 cents for every dollar goes to paying the interest expense on the debt. So they're really caught between a rock and a hard place because you gotta get the interest expense lower. That's number one. And maybe they're trying to just cut off liquidity here so they have the political capital to actually goose it again. And maybe that's what we're seeing is maybe Bitcoin sniffing this out is the drop in liquidity. And then when it reverses, we're going to get, Fed easing. We're going to start discounting Myron in early of next year. And then everything goes gangbusters again. One thing market structure wise is this is the big charade, right? Joe Saluzzi, he's a guy that he's an expert on equity market structure. He writes this note every once in a while. He's from Themis Trading about market structure. And I know people hate when I read from stuff, but he was talking about how this person from Hudson River Trading, which is a high frequency trading shop, was on Odd Lots. And they were talking about basically this magic money machine, which is they buy data feeds from all the exchanges and then they can front run everyone's orders, which is, it's like a little trick. And they hide behind the fact that, oh, it's liquidity and it keeps spreads collapsed. This is ground zero of market structure. But Joe writes in his morning note, the Hudson River Trading podcast confirms our long-held belief that prop data feeds sold by exchanges are the most important ingredient in the magical money machine. So this is just like a legal way to print money. All the major stock exchanges sell prop data feeds that contain every detail about displayed orders in an order-by-order basis, including order entry every time a unique order ID is entered. This order ID will reveal the historical details of such an order, such as the time of cancellation or revision. Sophisticated consumer of these data feeds can decipher patterns that emerge from certain market participants' algorithms and use them to their advantage. In other words, retail and institutional investors are the ones providing the market data that run the HFT magical money machine. We can talk about collocation. It basically says the magical money machine doesn't work if you can't read your data. So eventually, we could be getting to this point politically where the retail investors gotten screwed enough because we're now seeing this. You know what we're now seeing? This is the chart that we're now seeing. Crap like this. Go to slide 25. Because it's not a fair playing field, retail investors YOLO calls and then they go out and they do sports market betting. And then now they're doing all this crazy shit because they feel so screwed on actually investing over a long time frame that they end up doing. It's exactly the Bruce Springsteen song where it's like Atlantic City, where I bring this up all the time, but when your last ditch effort to stay ahead of like all the inflation is to just go try to do some crazy stuff to make your money back, that's what we're seeing. Like, we're seeing the market manifestation of all this stuff, which maybe is a market top. I don't know. I'm open to that, but I think the government will front run it and bail it out. But the point is the timeframes, and Joe says this, it's like most of today's stock market volume only cares about what will happen in the next few milliseconds and could care less about fundamentals. So there's like these HFTs have a legal, mandate to print money because they're liquidity providers, but they're really just front running on orders. And in the podcast, the person from Hudson River Trading even says, we essentially pick up pennies in front of a steamroller and like kind of admit that you front run your orders. So it's so messed up when you really break it down. It's the whole thing's an extraction mechanism, and it's not even, there's no long-term incentives for companies to really grow besides a few pockets in sectors. Like, I think that's the bottom line is what we're seeing is it's bad short-term decision-making gone run amok.
It's interesting to pair that too with what's been going on in the crypto markets the last 2 years is like sentiment has just been so terrible. And I think it's a similar thing where just it's just been highly negative expected value to be interested in almost any sort of altcoin over the last like 2-3 years almost. And it's because like the game is stacked against retail, like because of what's been going on the regulatory front, instead of, back in the day in 2018-19 where there was ICOs and there wasn't VC rounds. Like by the time a token gets public and publicly tradable now, the valuation is so stretched. And then there's just so much offloaded emissions from either the foundations or the VCs that are just being linearly unlocked for 4 years that the only chance that retail has to actually start to buy something is at the very tail end, right? Like it's just not a pretty sight. So they're just basically buying from all these emissions, and it's just a losing game. Like there just is not enough capital in retail to keep these things afloat. So I think it's good reason why you've seen like mostly only Bitcoin do well over the last couple of years, and people are just sick of it. Like nobody wants to bid these tokens anymore, and now they're just kind of falling by the wayside, and it's frustrating a lot of people.
Yeah, you go.
I was just gonna. I was gonna say, as for all of crypto's problems, like, and we've been DAT haters and grift. We're pretty moral, I think, people. And to be fair, like crypto grew because it gave like young people, fringe people, whatever, hope and the potential to 10x, 100x an opportunity just by plugging into the internet and being present and clued into the next sort of wave of financial services innovation, if that's what you want to call it. And it's really the only asset class ever to be grassroots first, where the average retail, average Joe, normie, everyday people could get in before Wall Street. And nothing ever has happened like that, pretty much. And now the internet enabled it. And now crypto's broken. Basically, it just got overrun with scams and grifts and extraction mechanisms. But you're seeing this in the public equity markets too, because AI is just like the traditional finance and everything else. Controlled by small cabals, restricted access. You're seeing these 100,000 X's getting run up in private markets and then dumping, let's say OpenAI, 1 trillion valuation.
1 trillion IPO. Exactly. Like that's not positive EV to be buying that on IPO. Like you are exit liquidity.
So you take away the average person's ability to afford anything. You take away because of that, you take away their ability to even be healthy themselves, their food insecurity. You can't afford good groceries. The food in the US sucks. You take away their ability to raise a family because they can't even barely provide for themselves. They sure as hell can't raise kids without parents and other sorts of, financial assistance. And then you take away their ability to even shoot up the ladder because public markets are dead. And if you think about what like high frequency trading and the algorithmic computer driven nature of the markets today, like theoretically, the market should get to a point where there's no drift like in the markets. It's just, I mean, there'll always be the drift, but it should just be zoop, zoop, zoop. Like the information gets to the highest frequency guys first. So there should become a point where there's like almost no way for, the average person to make money. And there's just like, you're going to get
longer time frame. I was going to say almost similar. I was going to say the whole funny part to this charade is that as long as Bitcoin and crypto keeps going up, you don't have, it's almost like the release valve of anger for the younger generation. It's their way to stay ahead of the inflation because their wages are not going up on an inflation weighted basis. So they say, no, you know what? My salary only went up 3% this year. Inflation's really like 7%, but I made, inflation adjusted with my capital gains 10%. I'm good. Like that. That's what keeps them okay. But if Bitcoin is not participating on an increasing rate or higher than that dilution of the currency, you have major problems because it's a demographic. And I think you're going to make more and more people extremists and fall into political categories you don't want to. And it's sad to say that. This is the game they created, is like, you need to have a release valve for the younger generation, because what are they going to do? They can't buy a building. Their wages aren't going up high enough to pay off their student loans. So, and the hard part is like, I actually feel really fortunate personally because I've traded it okay and like stayed ahead of it. And I bought a house when rates were low. Like, I feel horrible for Gen Z and the generation that didn't get it. Like, I see I'm close enough to see how it is and know that how messed up it is, having been a beneficiary of it. You know what I mean?
But you're like 4 steps down the ladder of the beneficiary. We're like, my generation's at like, we benefited because at least we still had job opportunities out of school. Now you have seeing announcements from the big banks saying, yeah, 1/3 of our junior headcount's getting cut, and the other third's moving to cheap labor countries. And then you're like, oh, by the way, all the DI, everything else, like there's youth unemployment. There's no way that reverses. That trend is only on a one-way direction.
What's like, one-way direction up too? My mom gets her pension and she lives in Princeton, New Jersey, and her property value goes up every year, and so the pension gets cost adjusted, and her Medicare is covered.
It's magic.
I mean, yeah. I hate to brag. I love my mom and my dad. They work their butts off, but it's really like, I don't know how it resets. Like,
yeah,
without political change. And not to roast all boomers, I really respect all you built, but like to act like it's working properly is just like, I don't think it's working.
Tyler, I love how you're just going through therapy with the comments of people that say
But I mean, like, my dad was a teacher, right? Like, he was a teacher when he could actually afford that.
Exactly. Then he should be able to relate, because a teacher now is like living on ramen noodles and has to rent a studio apartment.
Yeah.
It's so I actually want to pull up the Challenger job cuts while we're talking about this, because there's a couple interesting points in here. So this was quite surprising, especially because we got the ADP print this week as well, which is private payrolls, which is the best we got. And that was a pretty significant upside surprise. But we got the Challenger job layoff cuts here. And looking into some of the specifics is pretty interesting on where this came from. So in recent weeks, Target announced plans to eliminate 1,800 roles, or about 8% of their corporate jobs. Amazon slashing 14,000 corporate jobs. Paramount as well. And the reasons vary. United Parcel Service said last month that it cut operational workforce, which includes delivery drivers and package car handlers, by 34,000, about 70% more than it previously projected earlier this year. The package handler cited increased use of automation, which has driven up productivity. So that's really interesting. So you have that trend of automation, AI, productivity I want to mention. And then just this other one too, which is just the post-pandemic bloat. Like, you can all think of the day in the life product manager TikToks that were going viral over the last few years, where nobody's really working or doing anything. And there's a lot of bloat in that world of just like the middle manager, white collar world. And a lot of those are kind of being taken out to the woodshed too as well. And so it's it's dicey. I don't know. I'm curious to your guys' read if you've been thinking about this. Just again, it to me ties back to some of these key drivers of AI productivity automation, but then also just this pretty secular erosion of some of these more introductory white collar jobs, which then gets into the post college grad type of unemployment rate.
Throw slide 28 on there. This gives a better picture of what I think you're talking about. This is
oh yeah, nice. Yeah.
So you can kind of see AI chopping people up, and yeah, it's really scary out there.
I mean, you can go through this list and see. I mean, it's coming. Financial, that's coming. Media, I mean, like that's coming. It's creating all these. It's script writing. It's doing all this stuff. Consumer products, healthcare for sure. It's coming. Like automotive, government might be insulated because they're so slow to ever adopt any new technology. So they'll just be using snail mail for another 50 years. But like
we'll just all be working for the government, or we can keep our crappy little podcast. Everyone's gonna be working for Felix.
Yeah. Please, Lord.
We're just gonna be AI generated anyway, so we're screwed too. We've already trained the models enough with the amount of episodes we've done.
Yeah. They'll just give me a crappier haircut.
If you're thinking about buying crypto, but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
The reason, I mean, aside from being a first principles thinker and not just, fundamentally, principally not being able to just say, 4-year cycle, a multi-trillion-dollar asset just goes up and goes down on a predetermined course. So aside from those reasons, not believing the 4-year cycle, we've talked about it before. This setup is very different from 2022, where the Fed was purposefully removing the punch bowl into a maybe okay economy. Versus now you have midterm elections next year. And I mean, there's so many problems for the Republicans right now going into that. You have this government shutdown fiasco they need to make up for, which is brutal. They're reducing government spending, which we all know just isn't popular in an extremely populous time. You have momentum gaining on the mid-moneys, and super, so far, you look at all stock prices of lower middle income class Main Street companies and the inequality metrics, none of this has changed. So and the economy's weaker than when he came in, basically, or at least maybe it was running on fumes. So I think they were handed a steaming pile of shit for an economy that they tried to prop up and continue to. But it's more obvious to the public now because inflation's not going down anymore, and they're still, things are weakening. But the thing is we all know there's only one playbook to try and run to perform in the midterms next year. Yeah. Okay. Yeah. They can take pain right now because we're a year away. And so I think that's what this is. Notice how they haven't really, I guess Trump called Powell an nincompoop, but he's not. It doesn't feel like he's railing as hard as he was investing in any of these guys, because I think they know they're kind of willingly letting some of the air out of the bubble. But hell or high water, the only way to win midterms next year is to, 1, lift Main Street out of recession, 2, fire up your base, and 3, get markets cooking back to highs. And, with the Fed takeover.
Yeah, I think it's going to be a really good year still, and it's being set up right now. And I think the elections this week that happened, where Democrats just shot across the bow, they're we need to we need to get this in order. There's a headline today where Trump said like there's going to be no more tariffs for the short term horizon. Like I can't remember a time where he's been that explicit about being like there will be nothing coming out over the foreseeable future. And then I don't know. It's all about timing, right? Trying to time this, and we've been chopped up a couple of times thinking this was the one, and then you get stopped out pretty quick. But I don't know, more and more I'm still thinking that it is going to come across with this government shutdown and when that ends. And I think it's really interesting going into the weekend right now. So if you look at the last longest shutdown is in 2018, and what ended that shutdown was issues with airlines, air traffic controllers, and airports. So back then, I just grabbed this from it was a headline in CNN in 2019. And it's saying like, yeah, on January 24th, it seemed like the partial government shutdown will go on forever, leaving more than 800,000 federal workers unpaid. But then just 10 air traffic controllers decided to stay home and not go to work, and then instantly it was done. And then you look at what's coming up this weekend, and this just got announced yesterday, but the FAA will require airlines to begin cutting flights from these 40 airports starting as early as tomorrow. Airlines will start cutting 4% of flights per day until they reach 10% per day early next week. And I think we talked about this when there was the Air Canada strike in Canada and how the government had to intervene because, like, if you stop mobility of people to fly around and consume, if you stop the distribution of goods that's related to flights, like, your economy grinds to a halt. So I feel like this is going to get really close, and this is the crux to look at. But I'm curious how you guys are thinking about it.
Yeah, market will force their hand, just like
that's
everything
what we're
else.
watching. What's crazy is we've been really bullish and wrong on this last week or two, but so when you get the event of the clearance of the government shutdown, what happens to the VIX and all this? The VIX falls, all the puts roll off on the downside. The market, we're in buyback season. We're in low volatility season. Earnings have largely passed. So it's really
and you have the
hard.
TGA liquidity reverse because that's just been building and building and building. We're over $1 trillion now. As soon as that government shutdown ends, that gets reversed too. So that's why, yeah, it's like I can't stop being bullish, but I'm getting stopped out a bunch technically, man.
Yeah. What's funny is it's not even when you think about it. If you're not doing leverage trading, it's kind of easy to take the pullback. Here's just positioning wise. Check this out. This is a good one. 27, at least in the corn. This is a short term holder realized profit to loss ratio. It's from I stole this from the guys at OnRamp. They're in a pretty good newsletter. Sure. So you basically see like short-term holders capitulating. So potentially, like we could see this could be the lows, famous last words. And then look at slide 26, just to give you a sense of how far we've come, how fast. Where this is the Bitcoin futures curve, and you look at the white line is live, but I couldn't get it to go longer than this, and the orange line is what Bitcoin futures were pricing in a month ago. So a month ago, if you looked out, it was super steep, and we were looking at like 135.7 at the terminal futures contract was 137K Bitcoin, and look how far we've dropped in just a month in terms of where we're looking. It's kind of wild how fast sentiment changes. So I don't know. If you're just looking from purely sentiment, I think we're probably plumbing some sort of low here in the corn. I can't imagine unless there's credit problems and everything rolls out of bed. But there's not really, you don't really see that in the credit market just yet. So
yeah, it's a messy process. But like when we talk about 2026 and what's coming, like it's just I can't not try to catch one of these dimes.
Yeah.
It's painful right now.
It's maddening, right? Yeah.
Yeah.
But
my base case has shifted to this just being obviously, yeah, we were way wrong in our bullishness. A lot of great macro signs were there, and a bunch of events didn't go the right way. And, the tremors under the surface were probably percolating through sooner. So my base case has reverted to being like the standard pullback for the cycle. Because if you look back since 2023, and particularly since the ETF launch in Jan 24, Bitcoin's had like 5+ of these 25 to 30% drawdowns, which would put it like low to mid 90s. And it hasn't changed. Like none of them were the end of the cycle, in crypto speak. And we're not even to that level of normal Bitcoin drawdown of this quote unquote cycle. So it seems reasonable to me to expect testing. Like there's some definitely damage to the charts and momentum that needs to be worked through. You probably still have some long-term holders dumping on if we do get bounces here, and the DATs are absolutely annihilated. Like MicroStrategy and BMNR, who are the only two left, they're
cooked.
battered. So
yeah.
But are they below? They're below MNAV now.
I don't think
didn't see today.
MicroStrategy definitely isn't. But BMNR might be close.
Yeah, it's probably MicroStrategy is very close. BMNR probably is. The thing is, for me,
power law distribution of the rest of them are absolutely at deep discounts.
Yeah, there's going to be some marginal selling from those. I don't think BMNR and MSTR will sell. I think they have financing options. Like if you think about them, they can probably get 20 to 30% leverage LTV, and that offsets 20 to 30% of a premium discount. So I'm still not giga bear there. But the thing is, for me, is okay. I'm probably who knows? We'll see when it happens, and it depends what price this happens from. Because like if we puke in the market, like absolutely puke, and the market forces government shutdown, yeah, there should be a bounce from that. But whatever that bounce is, I'm kind of a seller because let's see, but where it comes from and what equity market structure looks like at the time and how prices are. But for me, the bigger problem here is the Fed. Like for me, the bigger problem is like pulling away the support that everybody was relying upon, and then adding in this balance sheet thing that is a negative and likely to increase as a negative. So I at least from a Bitcoin perspective, like stocks have earnings. From a liquidity perspective, the shutdown ending helps, but it's not the full solution, in my opinion, given the hawkish pivot.
I will say there's one thing you can pander to, what Trump really likes, is this has been a major policy of his, and he does not like the polls against him going lower, given his narcissism. And I could see them pulling out some sort of policy here just to, and how much of this, what I will say is like the market structures is really annoying. Like this is slide 24. This is like Wintermute. I don't even know what got caught up in the Binance Wintermute stuff, but this shows the breakdown of, all the different players in the game and changes in supply and NAV. But the market structure is so much different than it used to be. And the game is so much harder than it used to be. And it just feels, I think a lot of people are losing if you don't have a catalyst or for this to be a store of value, the confidence in this as an asset can go away. Is sort of what I'm saying.
Yeah. This was a great, I read this article this morning and it was good. And yeah, the kind of key point there was that traditionally most of the inflows were through stable coins in earlier cycles. And now you have the DATs and the ETFs. And yeah, the DATs, just retail's fed up of being exit liquidity for pipe investors, like at a 20 MNAV or whatever they launch at, just for it to end up at a discount. And so they can't purchase anymore. ETFs, yeah, you got some there, but there just isn't the same excitement right now. It's a really slow grind of an accumulation. And then the stablecoin volume, like to what we talked about earlier, is not that many people want to go on chain anymore when you're just, exit liquidity for foundations and VCs and on broken tokenomics. So it's just something needs to change.
How classic crypto is it for every single cycle, the people and firms that people sort of look up to, and then they they run some mass extraction playbook, like whether it's VCs dumping worthless altcoins, this time it's VCs dumping everything on retail via DATs. Like it's just time and time again, like And these are the people who are out there selling to institutions saying you should invest in our asset class. And then at the same time, generating
don't look at the tokenomics.
returns.
Don't look at
It's why, like, you can't have an environment where the quote unquote stewards of your industry are the ones pilfering it and robbing it blind and leaving it out to dry. Like, that'd be like if it's just ridiculous. So
I do think it's going to
in
get.
a way,
I do think we're working through the motions now, though. Like, I do want to end on a positive note, which is I do think it gets better, and like the market is refusing to pay up for DATs and for these highly inflated, low float, high FDV tokens anymore. Like, they're just done. So as that process evolves, and then you see new innovations, like MetaDAO has come out, and that's like a really great innovation in terms of better structuring these token launches. So I think it'll get better, but we're kind of chewing through the motions right now. So you sort of have that like version of a bear market going on right now, where we just need to evolve how we launch and structure these tokens.
You know what else is? There's a lot of other ideas that are working, that the incremental dollar is not going into crypto here, where, I mean, look at, it's probably overcooked.
Quantum and AI.
Exactly. And even if you look at weird, there's gold miners are actually really interesting because they're cash flowing like crazy now, and they're really they went through a 12, 13, 14, 15 year deleveraging, and now they really are, they're cheap in cash flowing. So I don't know, relatively to a lot of these altcoins that don't really have much value proposition and have huge market caps, geez, the gold miners are really screaming, and they're performing way better. So that's where I think a lot of the incremental money is going to.
Yeah, that's a great point. Like, if we want to get retail back in crypto, like, you got to give them a better product. You can't just keep fleecing them. Like, they'll eventually give up, and I think that's where we're at now.
Yeah. What's so hard is that, like, having seen the innovation of Ethereum and grabbing yield, and like, really is if they had the marketing pitch right about what it's supposed to do, which is you can save money at a higher interest rate than the TradFi system, and we're going to treat our projects so that they're low supply and you can get yield from it, and that's the promise. But I think it's get rich quick, and that ruins it, just like you said, the grift. But
yeah,
there's lots of things. There's actually a technological innovation there that has been unlocked, but like Aave needs to be like that guy. I don't know why that's not a front page story of like yield generation type thing of saving at a higher rate. But I think that's a great project.
Well, I think so I mean, we're kind of getting in the weeds now, but I think another big issue to solve too is just around like equity rights of these things. Like, Aave as a business is incredible, but is Aave the token good? I mean, yes, maybe there's some fee flow through, but you don't have the same equity claims as somebody that has equity in Aave, like the company itself does, than if you just own like this token. And you see this in other projects too, and this will be the big thing to figure out. Like, if you want these things to have a sustainable bid, they need to have a claim on cash flows. And if we need to deem them as securities, then let's do that and revisit securities laws to make them work for the 21st century and actually fix this stuff, because that's where we need to go. Like, this current setup is just, it's not working.
Felix for president. I don't even own Aave either, but I just think it's a good idea.
It's one of the best. Yeah.
You need protection mechanisms for investors.
I want to end on a funny note, but also a good note. So you guys might enjoy this one. But University of Austin put out this tweet that basically none of the kids going to University of Austin will pay tuition. And it was kind of like, because of student loans, like, these are the next generation of kids can't be hampered by debt, because those are the kids that are going to go pursue risk and create new things for the next 21st century economy. And this is where $100 million is donated by Jeff Yass to basically fund this for all these kids. It's incredible. Gotta love it. I think this is what like leaders really should do. And then you dig a little deeper. Jeff Yass like created Susquehanna, which is like, they just arm everything out, and they're the ones on the opposite side of the trade making money on every single trade. I gotta say, like, it's great. Susquehanna does an incredible job there, but in terms of the bell curve, they're making money on every derivatives trade. They are like Citadel and Virtu, just taxing. They're tax on the system. So shout out to Jeff Yass. Great. That we need more of that to keep the system going. But it's the irony. I think there's a European saying. It's like when you start donating money as a multi-billionaire, it's a sign to cover up all your sins. But in America, we don't think like that. It's like, oh, this will make me feel better. I'll get it back.
Yeah,
absolutely. We see Bill Gates, all these people.
Everything he did was legal. He's a free market capitalist. I shouldn't knock that.
And at least he's giving it back. Like all these clowns. Yeah. Look at, Pelosi's keeping her insider trading profits.
Yeah, but there's great people like Michael Dell. God, love that guy.
Legend.
There's people out there that do all sorts of great things. So it's not all bleak. It's just, we got to start rebuilding this thing on more firmer ground, because we see people falling through the cracks.
Exactly. Yeah. Build the foundation as a first turning. I think we can leave it there. That's a nice way to end it. Way to make us a bit more optimistic, Tyler. Thank you.
Yeah, there you go.
All right. Have a good weekend, everybody.
Take care, guys.